I would say our view of the mid-market is it's really a bifurcated market right now. And I think anytime you have something as seismic that happened as this pandemic, it creates winners and losers. In our portfolio, for example, we find that our consumer businesses, mostly that are focused on outdoor and athletic, are doing extraordinarily well right now. The industrial businesses in our portfolio are struggling. So, there's no one size fits all across the middle market. I think it is, case by case. Some companies are taking it a little bit harder, but I would say broadly, we think right now is a great time to be thinking about putting capital to work in this sector as companies' earnings are, generally down. Access to capital by other PE buyers is more limited, and pricing is more advantageous at this point. So we think today is a good time to be buying at the beginning of the cycle, but you do have to be careful about what company, how they're positioned, and how they're making it through the pandemic.
There's a healthy debate, you'll know, and you'll have been party to this for a very long time, as to whether the public equity markets are truly realizing the values of underlying business outside of the pure technology plays at this point. The momentum has been very much with what's perceived as growth tech. Do you feel that you are appropriately valued by the market as a diversified holding company that owns a lot of these mid-market businesses?
Yeah, so I don't think you'll ever get a CEO, very few that will come on and say the markets are appropriately valuing their business. I do think, though, the structure of the market right now has really changed, and there has been, through the pandemic, we all know that business, technology is becoming more prevalent in our life. I mean, look what we're doing today. We're doing a Zoom video call rather than being on set. And so, you're seeing the influence of technology, and everybody can really grasp that technology is clearly becoming more important. There's going to be a bigger component of GDP spent on it. And as a result of that, capital is, really pouring into that. I think what it's done is it's created in the public markets a real bifurcation where technology companies continue to get more and more capital, multiples continue to elevate more, higher and higher. And on the other hand, companies like ours, which are broad, diversified, have made it through the pandemic really well. Just to give you a sense, in the first 6 months, our earnings were only down 5%. But within that, our consumer, our branded consumer, which represents about 50% of our portfolio, was up almost 9%. So we've performed extremely well through the pandemic, yet capital is moving towards mostly the major, mega cap tech, the really liquid names, and a company like ours, I think, is, struggling to find, capital coming our way. So, we think there is a pretty big disconnect in valuation as it stands today, but generally those disconnects dissipate over time.
Elias, thank goodness I'm talking to a real businessman rather than someone who's obsessed by market and the Fed. Now, look, I want to know, you said you have, and I'll quote you, struggling to find capital coming our way. That's very different from struggling to find credit coming your way. We've got this major academic debate going on about the Fed at virtually zero rates and what they are and aren't doing as well. Are you having any problems accessing credit, not capital?
Yeah, so the credit markets are wide open, and they probably are bouncing somewhere between red hot and white hot. We were able to access the credit markets in May, and we raised $200 million of bond capital. Interestingly, the pricing we were able to attract was better than when we issued our bond in 2018. And we were at, arguably the depths of the pandemic with the US economy still closed in May when we did this. So the bond market remains really robust. We're seeing all financial institutions, in the credit markets, whether it be senior lenders all the way through bond investors, that have been very aggressive and are becoming increasingly more aggressive. But again, I'm going to make the point that it is a very bifurcated market. It's the haves and the have-nots. We are a very strong, performing, diversified credit. Our bondholders and our lenders can get a good handle on the earnings profile and also the risk profile of our company. And as a result, with all this capital that they have coming in, given the actions of the central banks around the world, they're looking for strong companies to put capital behind. We're a beneficiary of that. On the other hand, for our peers in the private equity universe who are looking to finance one-off businesses, that's more of a challenge today. So I do think it depends on how your company's positioned, where your access to credit is. But for those that are performing during the pandemic like we are, the access to credit has, I would say, never been stronger than it is today.